Today we have a very special guest. Brian Higgins is here. Brian, thank you for joining us.
Alex, thanks for having me today.
Of course. Brian is the co-founder, managing partner, and co-portfolio manager of King Street. King Street, a firm you launched in 1995, almost 30 years ago, is a $25 billion global alternative asset manager. Brian, you and I have known each other for many, many years, and I've always enjoyed our conversations. And I'm excited that listeners get to sit in on this one. So I'm looking forward to this.
Well, it's always been great. As I always say, the old friends are the best friends. And Alex, you've always been putting me to the test. So I enjoy our conversations always.
That's great. So today I'd like to cover 4 broad topics. We'll kick it off with your background, and we'll try to focus on things that somebody can't just read in your bio. We'll spend some time talking about risk, a topic that I know is near and dear to your heart. We'll get into the firm you've built very, very successfully. And then we'll end with your market outlook and areas that you're finding opportunities. Does that sound pretty good?
Sounds great. Look forward to it.
Okay, so let's kick it off. Would you just tell us who Brian Higgins is, your background, your experiences, your learnings that shaped your investment philosophy, your kind of core principles, your core investment principles, maybe even your life principles? Why don't we kick it off there?
Sure. So growing up in the East Coast and in New Jersey and being close to New York City and knowing people that were part of Wall Street always had an attraction because I saw people who were like myself. They were interesting, aggressive, thoughtful, and really just wanted to learn and understand things and felt that they had this ability to put things in the world in perspective. And as a constant learner, that was a very attractive proposition to me. And so growing up in a competitive family with siblings and focusing on sports and academics growing up, there was always lots of life lessons to be had. And it was something that, I'm a product of the 70s and 80s because born in 65, there was a lot of things happening, geopolitical as we have today. However, we had oil crises, we had Volcker, we had Reaganomics, we had a number of things that went on in the government that severely impacted the U.S. economy and things around the world. And so these seismic changes and movements in markets and economies tended to, invite a lot of curiosity and how it impacted me on a daily basis and our family. And that curiosity and the ability to make sense of things, I think, was a big driver in growing up, going and pursuing a career on Wall Street, where I thought all the answers would be. And frankly, working in hard in something and being rewarded. And I felt that some of the big corporations I saw through family, neighbors, et cetera, there was a lot of politics. And Wall Street always seemed to be a place that if you did well, you performed, you got compensated, more of a eat what you kill type mentality.
Okay. And then within that world, the investment world, was there something specific about kind of the credit side that drew you to that segment?
Well, when I started in 87 out of university, I started at First Boston, which then became Credit Suisse, then became UBS at the moment. And so it was a heady day at the time, 87, which followed by the crash in October. But in 87, there was lots of mergers going on. There was a lot of activity. And I started in the merchant banking department, which a lot of these mergers were debt fueled, and they were raising a lot of this new product called high yield securities or junk bonds. And the era of Michael Milken and Drexel Burnham. And First Boston was also a big user and issuer of these junk bonds. And like anything, when there's excesses in a market, there create opportunities. And so excesses follow a deficit of capital, and things dislocate quite dramatically as they did post the crash, and financing got quite expensive. You saw Drexel go out of business. And so starting out as I did on the advisory side and merchant banking, where we were doing proprietary deals for the firm, and then later saw some of those deals crater, go into Chapter 11, which caused financial stress for First Boston and then had to be bailed out by Credit Suisse. You see the downside, and so credit, a lot of volatility within credit, a lot of volatility, more equity-like. However, if you structure it appropriately, you could protect yourself. And I think as time went on, I would learned, firsthand, and certainly as we later traded distressed securities proprietarily on the high yield desk, we were seeing as this market dislocated, many of the opportunities that were created out of this severe dislocation. And we were able to participate with equity-like returns in these fixed income securities. And I said, hey, wait, this is a pretty attractive area where if you do your work, you understand the financials. And I think there's a complacency that at times comes into the fixed income markets. And we were able to take advantage of that as things weren't adequately priced in terms of risk reward perspective.
And then in your kind of early years, what I've learned through experience and meeting successful investors is their core investment principles were oftentimes shaped by their early experiences. You're kind of green and you're learning a lot in the beginning. Were there certain experiences for you that shaped kind of the investor you are today?
Yeah, as I said, starting in July of '87 and a couple months later having Black Monday and the stock, crashing and stocks crashing and people getting laid off and the world's going to end, and then see it rebound quite quickly. And then seeing the firm that I worked in, the heyday firm that all of a sudden its existence was being called into question. Then seeing Drexel one day issuing commercial paper, the next day going bankrupt. These stark juxtapositions of everything's great, nothing to see here, and then everything ends. I think that shaped in terms of, hey, there can't be complacency. Hey, are we really pricing risk appropriately? I joke. People say, what are the things about King Street down? And I say, well, paranoia and insecurity. And I think it's important to look at, hey, what am I missing? And that constant learning desire is important in risk management, and looking at, what is the appropriate assessment for the companies that you're underwriting, because too many times, there's a tendency to go with status quo, that the price is justified, and really many times it's there's an opportunity there, like anything. I mean, our job is to find out where people are wrong.
It's pretty remarkable where things could look perfectly fine one day and then literally a day or two later you're out of business. And we've seen it, recently with SVB and others. But it's pretty remarkable that that can actually happen, and blindside those who know these companies and industries extremely well. It's pretty remarkable.
Yeah, and the SVB and other, in terms of it was in held to maturity, it was okay. People looked at the way they funded their balance sheet. We saw with Lehman and Bear Stearns, they didn't have adequate protection in terms of financing. And so, I think it's when the confidence erodes and you are incredibly levered. Let's be clear here. Now, many of these banks are much better. They're not as levered as they were. And in the case of the SVB and Signature, et cetera, those banks were, levered to these deposits, and these short duration deposits that, could be pulled at a moment's notice. And once the confidence game, ended, then their existence was called into question.
Yeah, it's pretty fascinating where you can hit a tipping point and it's game over, just like that.
Yeah. So as we look at opportunities, and the biggest thing about King Street is seeing this volatility. I say, well, let's just not wait for these opportunities to create themselves. Perhaps there's a cheap optionality created by participating on the short side. So as we look at both short and long. And I jokingly refer to ourselves as a short long investor. And people say, don't you mean long short? And I said, no, because the orientation for us, many of our biggest longs that we've been successful in over our near 30-year history started out as short positions. And I think that ability, again, to be agnostic in terms and just be arbiters of value and not so wedded to, one way to make money. I think that's important, is to develop this convexity and that downside protection, and that all goes into, how do we structure our portfolio to, participate and really truly be, as you said, alternative manager, but we're an absolute return manager. It's not, we can't say to our investors, well, relatively speaking, we did, okay. And people say, I don't care. You're an absolute return manager. Make money no matter what. And that's a great discipline that is, important, that we always keep in mind.
Yeah, and it sounds like from your early experiences that your orientation is absolute return minded. It's a different mindset. There's a lot of relative return managers where they're just trying to beat their index. The index is down 20, they're down 16, and they feel like they've outperformed. And I guess your early days and the experience of the downside drew you into a more absolute return oriented strategy. I guess does that make sense?
Yeah, and as we look at markets across the world, and our job, and we have a global presence, is to find the best risk-adjusted return around the world. Whether it's something in Asia, Europe, U.S., and where we are in the capital structure, where we are, because debt securities that trade at a discount are really like equity, and so we have to be mindful about what the risks we're taking. There's no ability to make money in absence of risk. It's just something that I think it might be perceived as such. There's no free lunch, as they say. And so when we're presented with someone say, oh, there's nothing to do in U.S. Distress today. And there is stuff, but it's limited relative to past cycles where you have 10% defaults and it's just like shooting fish in a barrel. Now there's many different products to be able to, on the private credit side, on the bank side, on the structured credit, looking at loans, looking at opportunities, as I said, throughout Asia and Europe. And that ability to be flexible in the mandate while we're still staying true to our bond picking, fixed income orientation, I think is important, and that we're, and also then again the short side, and saying, we're not just going to sit there and say, sorry, we got all this cash and we're just going to sit on our hands. I think, it's incumbent upon us to make money, again, no matter what, because there's always volatility to capture, and our ability to curate credit is so important as we look to differentiate our offering.
Yeah, that makes sense. Why don't we transition to the topic of risk? You touched on it a few times earlier, but I feel like it's just a very difficult concept to get your arms around, because returns you can see, risk doesn't really show itself very often. Would you spend some time talking about how you think about risk?
Sure. I mean, we talk about risk-adjusted returns, and many times people kind of give you the 1,000-mile stare. And so, because they'll say, I don't care, I just want the returns, until there's a unfortunate event that occurs in a particular firm that you thought they were doing risk management, but it's sort of after the fact. There's a hard conversation about it. We don't plan on having those hard conversations. And so, I guess, again, back to my upbringings of going through the 70s and 80s and seeing all sorts of volatility and how difficult markets and economies can get. And certainly it goes back to, all right, risk management starts brick by brick. And I think I remember back in 2008, and we had interviewed a bunch of these chief risk officers from some of the biggest investment banks at the time. And as you might imagine, many of them have kind of missed it. And we were saying, all right, we want to continue. We made money in 2008, and yet we still wanted to, bolster our risk department, continue to grow it. and make sure can we learn. All these risk people were available, obviously, because they had sort of missed it. And what struck me is many of these CROs, chief risk officers of these larger firms, were talking in generalities, and they were talking in terms of the portfolio and the markets and these correlates, et cetera. And I said, well, what is your view on, XYZ credit in this particular industry? And they said, well, we don't look at that. I said, well, how do you really understand the risk if you're not understanding what the downside? And so I think, and particularly, I mean, what we do, it's so single name driven. However, we also look at the barbell because there is a pattern recognition that occurs within markets that's why people hire us, because we're 30 years of experience. We've seen many different markets. I've lived through many different markets. Been doing this since '87 in distressed and leveraged securities. And so that kind of experience is very difficult to replicate. And so living through those scenarios can give you this added texture and substance that comes with this risk model that is really empirical, and you might talk about in broad brushes, strokes about how risk models operate, but until you say, okay, let's prove a mark, right? Let's see if this can trade. So what does liquidity really mean? And there's many different assumptions, but if you're in a offered and no bid market, what is the price? How are you going to price your portfolio? And so one of the big things that we look at from a risk perspective is what's the liquidity? And in difficult times, understanding that you got to discount for size, you got to discount for credit risk, because there are less and less people that are willing or able to hold those securities. And so then your recovery value is going to be a lot lower. And one could say it's too draconian, et cetera. And yeah, that might be fine. However, if you can't live and survive through those moments to then take advantage of those markets, you got to live to take advantage of those moments, because then you could say, all right, I believe we weathered the worst of it. The portfolio was designed and structured to sustain, and then take advantage on the upside of those situations, because many of these single name values traded, below liquidation value or what have you, depending on the severity of the market at the time. And so when we look at our risk management system, it's slicing and dicing it every which way. What is our rate risk? What is our spread risk? What are the different scenarios that can happen, both equity and fixed income? And then you got to think about, okay, if we have always a short perspective and a long perspective and exposure on both sides, you can't win both ways, right? You can't be making money on your long side and then making money on your short side. There's then you overlay what's your house view. What do you think spread's going to do? What do you think the economy's going to do? What do you think rate's going to do? And that's where that, top versus bottom, that barbell approach to risk management is so critical. I think, we've seen it where, okay, great, you pick the greatest names that things talked about earlier. However, if the overall market's down massively and you're long and you're extended, you're going to lose money. So you're not going to be able to deliver on the absolute return promise. And so as we think about risk management, it's pervasive. I want to push down risk management onto every one of the traders and analysts that are offering, suggestions on investment ideas. And really, will we pair people up with a robust trading team, paired up with the analysts, and then looking at also the sourcing. So I want to source differentiated risk. I want to make sure that we have a differentiated view, why we have an edge on being able to understand it. And then what do we think about the liquidity to be able to, exit that risk or add more to that risk? And in a difficulty, what's going to happen? Who else are you in that credit with? That's just not like, look at my portfolio. This is sort of a relational credit risk management, if you will, right? I think many times, like, oh, I'm with, a bunch of leveraged hedge funds that are, tourists in the distressed market. And that's who the other people that own. Well, if things get difficulty in those markets and they have much tighter risk tolerances to any sort of volatility, then they're going to be first to sell. And so you're going to see the bottom drop out in terms of valuations, and they're likely to overshoot dramatically on any risk model that you might have employed. So it's important, again, to understand who you're in the credit with, who are the other people in the company that owns it with you.
Yeah, you just covered a lot there. And basically, risk is multidimensional. It's top down, so thinking of kind of the big picture things. It's bottom up, looking at security by security. And then you got to also look at who else are you in those investments with. And that whole perspective gives you a much broader understanding of what the underlying risks are.
Yeah, and then things will happen, and you're like, oh, geez, I didn't even think about that. So it's that back to never stop learning. Back to I'm the humbleness where like I'm still trying to figure this out. The work is never done.
Yeah, I mean, I've known you for about a decade, and what has it's always struck me is, despite all your success and what you've accomplished, you remain very humble. You're always worried about what are you missing, what's around the corner that you're not seeing, what can cause significant losses. Maybe spend a few minutes talking about the mindset that comes along with that orientation.
I think, again, traces back to early days and seeing some of the seismic shifts that went on and during the 70s and 80s. I also think that as we look at these big companies, and I started in my business, and companies that are top of the world, then they fell dramatically. You look at the big brokerage firms and Lehman and Bear Stearns, and they were the top of their game. And so I think, like anything, it's important to remember that there's excesses, and you have to be constantly vigilant, hyper vigilant to, what are you missing? Why am I so lucky? And I think, in the investment world, we look at our, win-loss ratio, if you will, investments that made money, investments that lost money over time. And they're really not that high over, 56, 60%, whatever the numbers are, depending on the year. Obviously bull market years, everything makes money, difficult years, so and so. But if you look over time, almost 30 years, it's not a huge number. And people would say, well, that's sort of strange. Now, what is exceptional is the winners are bigger and the losers are smaller, and ability to cut sooner. It's sort of, if you think about, you're wrong and you're starting to lose money. Well, it's like the 5 stages of grief, right? You got to be like, denial and anger, denial, acceptance, get to acceptance as quickly as possible and say, hey, I got it wrong. And that's why that humility is so critical, to be able to, own up to a bad investment. I have friends of mine who are, legendary investors in the macro world. And if you talk to them a couple of times a week, you might get a couple different views. And so I think it's important that, when we don't have portfolios that you can change your mind, every day. However, it is important to understand that, how we frame the markets is something that should be altered as new information comes on, because you'll talk to somebody and you'll be like, wow, they really know that credit. How I even own this situation? They know it so much better than we do. Geez, I got to get out of this, or double down the efforts to to learn it. And so there's really smart people in this world. There's really, and again, sports, and I like watching sports, try to participate in sports time to time. That also, it's like anything else, you lose your edge if you not continue to work hard. There's always someone smarter, always someone faster. And I think, businesses, it's a global market, you're competing against, imports, you're competing against, domestic, in corporate world. And so I think, anything one does in life, they would be incredibly naive to think that they can operate, as an island and not be subject to intense pressure, and requiring, this humility to continue to question, why am I so lucky to understand this better than the rest. And we're not always in that case. And there's plenty of evidence we get every day. The market tells you, you're not that smart. And that's okay, because it means, I'm a competitive person, and I'm going to, double my efforts to find the answer.
Yeah, there's a bunch of things there that you said that I think are really insightful. One is, 55 or 60% hit rate in this industry is really good. And you think about most other industries, the hit rate is much higher. And so that's pretty unique to the investment world. And it's because markets are relatively efficient. They're really smart players. It's constantly evolving and so on. So I think that is just really insightful. A lot of people, I don't think, take an honest, accounting of their personal track record. Their selective memory. Most people remember the winners and they forget the losers. But I think it's important to have that honest track record. And, if you think about somebody who's been in the business for 30, 40 years, they feel like they've seen it all. And it's easy to become overconfident in your ability to increase your hit rate. And I think it's a very unique orientation to be always worried and thinking about the things that you're missing and that there's smarter people out there and so on. So all that I think is just fascinating.
I don't know about you, but any of the people who've been doing it a lot longer than they're always the most insecure and,
Well, those are the survivors, you
that's
know?
true. As the old saying says, there's old traders, there's bold traders, but there's no old, bold traders, right?
That's right.
So, but yeah, I mean, the people that, I've seen been incredibly successful over long periods of time, they joke that they lost their edge, right? So they sometimes surround themselves with younger people, and I think that's always the important component of these organizations, is to continue to evolve and continue to add, and as I say, the new talent, the old talent, and that blend to provide the judgment coupled with this intensity and renewed interest, because I think sometimes the newer perspectives are important to embrace.
Yeah, when I look at the great investors of our time who have been around a long time, I think the one thing that separates them from others, obviously they're all smart and competitive and focus on learning and surrounding themselves with smart people. But I think the one ingredient that separates them is their worry of catastrophic loss and what they're missing. And if you think about it, if you're in this business a long time, you avoided catastrophic loss. And that should always be priority number one. And I think the ones that become complacent and lower that in their priority list are the ones that are kind of doomed for failure at some point.
So there was a investor, Marty Whitman, MJ Whitman, and he used to talk about there's always another trolley car. I mean, there's always another opportunity that is coming down the pike. And so Charlie Munger and Warren Buffett, all these guys have always said, to your point about managing these large losses. And I always say, worry about the downside. The upside takes care of itself, just because of natural inflation and progression of growth of businesses on average. So, you just have to, avoid some of the real dogs, and the portfolio will naturally, inflate for you.
Yeah, completely agreed. Why don't we spend some time talking about King Street? You started it about 30 years ago, a little less than 30 years ago. Would you maybe spend some time talking about why you decided to launch your own business? It was basically your second job out of school, and you chose Fran Biondi as your partner. Why did that fit, and why were you so confident, or were you confident that you'd succeed in in an industry that has generally low odds of success?
When I was a kid, I mean, I had lots of odd jobs, but turned them into my own businesses. I had a lawn cutting business in high school where I had all these customers, and I employed a couple of my high school classmates. I had a car freshman year, and so went to get beer and resell it in the dorm. And then remember, I did the purchase or sort of gift with purchase program where I print up all these boxers with the college logo on it. And, at the tailgates for football games, I would say, buy a beer, get a boxer. And so I had these boxers that would give out, but they would sell with beers. And so I always felt that I'd like to control my destiny, as it were. Again, being product of the 70s, 80s, a lot of layoffs and, unsure economies. And I said, well, if I'm going to work hard, I want to sort of be in better control of my destiny. And so that was sort of always the mindset, entrepreneurial mindset that I had as I approached business. And so at First Boston, when I went from the banking department down to, it was a newly formed group, this distressed securities group, part of the high yield department, but we were our own self-contained business. And then within the firm, we left and started our own internal hedge fund. So in reality, being at a big firm, even within the first, say, 7 years, I had started two businesses, at First Boston. And so I had really a track record growing up, and then in my corporate life, even in a big firm. If you've been in a big firm and you know how bureaucratic and stilted they can be, to start a company within a large bank is no easy feat. And so I said, geez, this will be easy, out on my own without all the regulatory rigmarole that was required to deal with a distressed security hedge fund within a large corporate bank, particularly one that was struggling with capital allocation issues. So from a, let's call it, operational perspective, I didn't see it being much of a challenge relative to how I went through. And then we also were, Fran and I, we started in the analyst training program together, so we've known each other since the beginning of our careers. We had worked together at this internal hedge fund. We had both been independently and collectively profitable. So there was also this belief that, hey, we can do this. And we felt comfortable with our ability to work hard and have a differentiated offering that was out there. And it still was, the credit hedge fund world wasn't as large as it is today. There's never any guarantee of success. We just felt that we were good as any, and frankly we were young. I mean, I was 29 years old. I'm like, okay, I'm single. It's what's the worst can happen? I can just go get a job at a big bank if this thing doesn't work out. And I was in a rental apartment, and so let's give it a go.
It's pretty exciting, and I guess it's really. I'm sure you enjoy looking back on your journey and where you started and kind of where you've come. It's got to be very gratifying. Yet you know that it's not over. Obviously, you've got a long way to go.
Yeah, it's funny. I remember years ago. I'm an okay skier. Snow skiing. I prefer golf versus skiing. But back in the day, I went. Took a rare vacation and said I'm going to hire an instructor, some young kid that's going to ski with me and ski with me for a week. And by the end, I liked to ski at the time. Moguls, my body couldn't take it today. I would fall apart after the first couple of moguls. But at the time, I was pointing the skis downhill, and I wanted to be like the guys in that video. And so I'm sure I looked nothing like it, but inside I felt like, yeah, I was one of these guys in the ski videos, and I was doing the first couple of large moguls. And for me, I was doing it very well. And I then said to myself, hey, I'm doing this. And immediately, of course, I face planted, skis ripped off. In fact, I ripped the binding from the ski. So I literally do the walk of shame, walk down the entire mountain the rest of the way, and go sit at the bar and have to explain, make up some really glamour story about, I was doing some triple black diamond, whatever. But the reality was, I let it get to me. I sort of said, oh, yeah, I'm doing this. I got this. And immediately came crashing down. So I think that's sort of emblematic of how I approach life is I never want to look down, never want to look back. I always think about the new challenge and think about this is a 30-year-old startup. And I think having that mentality is critical because, there's always someone new coming out there. And I have to approach it as, there's new investors we're talking to all the time. There's new markets that we're entering, if you will, and it's a all within the fixed income world. However, new markets are being evolved and created, and so I think it's important that any company that wants to survive the test of time is to approach it like you're a startup, and because in certain areas they view you as such because it's a new relationship to them. And ours is always about new relationships because we got to make sure that we're availing ourselves to any of the opportunities that present themselves around the world.
Yeah. So you start this firm and you have an investment philosophy and core principles. Would you talk through that a little bit? Obviously, we've touched on a lot of it so far, but just your investment philosophy and how you think you differentiate yourself from, the stiff competition in the space.
Sure. So Kingshare has always been about looking at, as I said earlier, downside protection, looking at how do we create equity-like returns out of income securities. How do we look at complicated situations and be able to distill the risks and the opportunities that are presented in those situations? I mentioned the short side. I think that's a powerful orientation differentiator because many times people wait for things to fall and then they go in and investigate. I think being early in that situation, being on the short side, them covering and going long is important to be able to risk manage and capture as much of the call it alpha, although I hate that expression, create much of the opportunity for profits as you can. I also think, as I talked earlier, about having the trading desk and being able to, price illiquidity. I think people can price liquidity, but you got to price illiquidity. Always look at the downside. I think that's an important differentiator. I think it's important to, as I said earlier, to manage both the macro and the micro as one looks at putting together these long short portfolios. I think again the global participation to be able to analyze global markets. Many times we will have we have a smaller allocation to Asia in terms of our long short exposure. However, it factors importantly into our decision making ability to analyze credit and opportunities. And we've seen opportunities that we source in the U.S. and Europe that have been sourced by our Asian team. So I think it's a really a combination of things. It's also not one thing at a particular period of time because we're always thinking about tools in the toolbox, and to the extent we can grow that toolbox as big as possible, and you never know which tool you'll need to prosecute the opportunity at a given time in a particular market. But we believe having this agnostic view, not only long short, but as where we're going to deploy credit. We've heard over the years people say, "Oh, I'm going to open up in Asia, and I'm going to give them 500 million, a billion, what have you, allocate to them," and then it's just allocated, and then there's not a, hey, are things more interesting in Europe or U.S.? Should I even be investing in Asia? We roll everything up in terms of risk to our global investment committee, which then, we're incentivized to find the best relative risk, regardless of where you found it in the world. And that's important that people know that they're compensated on the overall book versus on their in particular book. Because if you start the year and you say to the different regions and different products, high yield, IG, structured credit, you say, how do you think your year is going to be? They're going to say, oh, it's going to be great. You should allocate the entirety of capital to me because I'm going to make the most money. Who wouldn't say that, right? They're competitive people. They believe in what they do. However, we would say, all right, tap the brakes. As you find ideas, let's look at them. And so one of the things we also do is we do what's called a buy-sell meeting, and we do that every 4 to 6 weeks as needed, and we look at every single line of risk in the portfolio, and everyone participates. It happens over 2 days, and it's important that the other people within the firm see about what's compelling in those different markets, in those different opportunity sets, and what kind of risk reward is available. And if they're looking at some, they're saying, oh, mine's kind of cool. It's an 8%. I think it's a little low, but I think it's super interesting. And everyone's like, yeah, I got this 12%er, and they're like, oh, wow. Okay. So that is the knowledge transfer. That is the ability to ensure that people are on the same page. They understand, what we're striving for. Also, we look at our house view. We look at what do we think the market's going to do? What do we think is going to happen? Then we continue to evolve it. We have a 3-month view and a 12-month view, and we continue to say near term, what do you think is going to happen? So if we're tactical, we can reposition the portfolio to capture that. Over the 12-month, obviously we're not going to day trade all our positions. So, what do we think is going to happen to set up to make money? And that way, there's this common, understanding. Now, again, I say to people in the house view, there's room for different views within the house, and so it doesn't have to be, so prescriptive that it doesn't give room for difference of opinion. Because, as I said earlier, right, we approach it as like paranoia and security. You never know where that new information is going to come from, and oftentimes it can come internally when someone on your team is like, hey, I've been reading this and I think this is kind of interesting. This is kind of a game changer, sentiment changer. Or I talked to this this person over here and they kind of got a differentiated view on things. You want to encourage that information. So it's important that you don't have this group think where there's a ability to receive new information, and that's something that frankly we all need to get better at. I just think it's endemic on so many levels that there's not as much open-mindedness as need be.
Yeah, and I think that goes back to what you said earlier, which is if your hit rate is 55 to 60%, if you're really good, you should recognize that you're wrong a lot, almost half the time. And I think if you're in the position where you don't want to listen to different perspectives, you're probably overconfident that you're right more than 55 to 60%.
Yeah, and I do think that the more talented people are the more unsure people, if that makes sense. And I think it's because the more talented people are the people that can take in more information, can be able to understand many different scenarios, and they can understand that there are many factors that will influence valuations in markets and particular credits. The less talented, the very one-dimensional individuals who are incapable of sort of synthesizing, because that's what we do, right? We're pattern recognition, and in order to see many different patterns and what can occur in the different probability weighting, we think about it, all the time. I talk about it as proportionality and probability with any investment, right? Because one can convince oneself to not do any investment, or convince oneself to do every investment, right? Based on the probability of proportionality. And you can say that will never happen in a million years. And you could buy everything, right? And it will only impact, this particular fraction of the market or this particular part of the credit that you're investing in. But again, you flip that around and, it can make you bullish or bearish to extreme degrees based on probability and proportionality. So I think, as we look at these situations, that's another thing that we try to keep in mind at all times.
Yeah, let's talk about building a great firm. You have 250 people. How do you find 250 great people? How do you continue to scale? And how do you mentor, inspire, and instill your principles as you scale up?
Well, it's some of the things that we talked about in terms of the activities, our Monday morning meeting, something else we do, the buy-sell meeting I mentioned, the ability to collaborate on individual credits, the ability to come in weekly trader meetings to say, all right, what do they see in different sectors? So if we're always talking about relative value, if we're always talking about how markets are interesting, differentiated, we have our team come in, twice a year and, work, in New York with us on the investment side and the whole firm. We've had them come in December to get together and have a lot of activities. One of the things we looked at, and we've been one of our more popular sessions that we put on during our King Street week is the, what went wrong. And it's, taking some of the investment situations that, did not go well and, why did we screw it up? And I think that's important for all to say, oh, okay, it's good because King Street can be, self-facing, can be, have that humility, can actually, if we don't create an environment where people can admit they're wrong, then, you're going to have these disproportionate losses because you got to quickly recognize, that got to cut risk on situations where the thesis is not played out. And so, that's something that we intensely focus on. We celebrate longevity. We have over 75 people that have been with us over 10 years currently at King Street. However, we're always bringing in new blood, and we want to continue to our best people have been promoted from within and homegrown. I think that's important. And so as we look at the firm and look at how we structure both the front and the back office, we talk about the integration between the two. Many of our complicated situations are hand and glove process whereby the legal team works closely with the analysts and the traders and the operations team to make sure that everyone is diligencing and working together to analyze and to structure the investment that is best protects King Street. And so, that spirit of collaboration, as I said earlier, if we're working towards one portfolio, that's important as well, is that when opportunities come into King Street, we call overlapping circles, which is like, okay, part of this investment can go in the hedge fund, part of this can go in the drawdown funds, and we could share in that risk. And so the sourcing and the analyzing of that risk is shared, and the upside shared by the different teams within the firm. And that helps that spirit of collaboration. There's always the events, whether it's charitable events that we work towards spending time together, or just summer outings or things like that. I think we work very hard, but we try to enjoy ourselves as well, and generally like each other, and try to work together with that one common goal. And I think it's important to understand, King Street, we're always, incredibly focused on doing the right thing, which, I think there's no cutting corners on that. So that's all part of the ethos and part of the culture that we've built together. And it's really about the people and the camaraderie that it results from common goal, and try and do things the right way at all times.
Yeah, I mean, there are countless examples of small firms growing too big. They lose quality as they scale up. The culture isn't what it was when it was a smaller firm. They get complacent. The competition eventually passes them up. So I guess to keep that from happening, your DNA has to flow through to every employee. And that has a lot to do with it's the messaging, it's leading by example, it's some of the policies and procedures you've established. You make it sound very easy, but from my experience and seeing a lot of managers, they don't pull that off very well.
Well, I mean, nothing's easy. I think it's important too when people come on board. I always say to them, "Hey, you've worked at these great firms. What'd you learn? Okay, Goldman Sachs or Blackstone. I mean, BlackRock, or these are massive firms. What did they do there?" And I think that's important to be. There's a King Street way. However, it continued to evolve if there's a better way. And we don't have it goes back to that arrogance, right? You can't have this arrogance that this is the only way to do it, it's our way or the highway. And I think that is important to keep in mind, and we continually focus on is we got new people coming in all the time, but this is core group of people have been with us for quite some time. And I think there's that something old, something new.
And how do you think about scaling as it relates to returns? Is getting bigger good for returns? Is it bad for returns? How do you think about that tension?
I think in the markets, as I see, the markets we operate are massive, right? There's multi-trillion-dollar markets. So the important thing from our perspective to monitor is, are we big enough to be relevant? Which we are, plenty big enough. And then to your point is, are we too big? Some of these funds, they're, raise funds as big as our total AUM in a single go. And they'll say, oh, and we see all the opportunities. And I'll say, yeah, but you have to do all the opportunities. And I think that ability to be selective yet see the opportunity set is an important distinction. And so I've always felt that, we're not, at least King Street has never been, and I don't foresee us ever being in an asset gathering mode. And that's, we want to be relevant. We want to be able to, compensate the best people and be able to offer the best risk-adjusted return for our clients. And that's an art, not a science. Obviously, if the markets go straight up and you're long, you're a genius. If they're dislocated and you try to reduce risk, but you have too much in a particular subsector, then you're too big. So, but I think I've been doing this long enough to know what sizes, and we have quite large markets. It also helps that we've been around for a long time. Many of the relationships that I forged when I first started are now very senior levels. So our counterpart relationships are quite broad and deep around the world, and that's those are important differentiators that enable us to source interesting risk, and again to offer our perspective on markets and situations, because there's always this partnership aspect, whether it's with clients or it's with counterparties that are looking to move risk. They want to make sure that they're dealing with some of the experienced hands that are also incentivized the right way. I think we've seen at times, that businesses that get too big, their incentives are not aligned because, they're not able also to be solution providers to the clients as we can.
Yeah, in our industry, in the investment management industry, if you're too small, you can't really attract the best people and keep them. If you're too big, your universe of available investment options shrinks, and there's a kind of a not too hot, not too cold, right in the middle, and that's subjective. But generally speaking, it seems like that's how you think about it as well.
Yeah, that's fair.
Why don't we talk about the market and your outlook? If you kind of start from a very high level and you zoom out, you had 40 years of falling inflation, falling interest rates, and it's very possible we hit a major inflection point and we're in a higher for longer environment, and that's still yet to be seen, but it seems that way at least to this point. So, how do you think about, from a very big picture, where are we headed, and then we'll zoom in a little bit on maybe some specific opportunities that you're seeing.
Sure. So obviously, as you pointed out, we've had 82, 40 years forward. There's been, massive one-way, jagged downward trend, but generally downward trend towards rates, and then, zero rates, and then, pandemic, et cetera. And, we all know, and part of the stuff is people underestimated, how quickly rates could go up. And then I think they're overestimated how quickly they can go down. And you look at the performance in the last couple of months, it's been stunning, right? You had IG, down 1.5 in October, really not much in stocks, et cetera. And then just, November, December, been massive. And some would say pull forward of returns from 94 into 2023. Certainly you saw that in some of the high yield situations as they retraced to begin 2024. And we're seeing dispersion increase where, the have and have nots continues to increase. There are certainly, there's still a lot of liquidity out there. Financial conditions index continues to improve, particularly when you see asset prices reflate as quickly as they have. There was this, Fed said, 3 and the market priced in 6 rate cuts. And now the market's like, well, maybe it's not that much, right? Because from our perspective, looking at this 6 rate cuts, well, geez, it's can't, how are you going to have a no landing, soft landing, right? Or stick to landing, whatever they want to call it. Now, I'm not saying there's going to be a hard landing, but I could see a soft landing and then gradually going into a harder landing as the economy goes on, principally because of the debt loads that are out there. And I do think observing some of the predictions on GDP growth globally, they're not talking about robust, real or nominal growth here. And so the challenge is going to be also from a liquidity perspective. If you think about the funding needs, because a lot of this has been central bank propagated, because not only on monetary but fiscal policy, a lot of the largesse that has incurred. And fine, they've done some QT, but they continue to print on the fiscal side. So you had a 6%, fiscal deficit in the United States, and we've blown up the debt loads. And going forward, there's going to be a competition for capital in our mind as you look at both on the government side competing against the funding that is going to be required on the corporate side as this maturity wall is hit, in real estate and corporate bonds. Now, it's come off the wides recently in the last couple months, as you saw this big rally in credit that we talked about, and equities. And so people are refinancing and they're racing to refinance now. So there's a massive now there's still $2.5 trillion or whatever the number is of equity that needs to be spent by private equity. And so they're getting a lot of pressure and they're like, use it or lose it. So they have to price. And so there's going to be more debt issued from that. And so I just look at the different pockets of funding that will be required, which I think is going to be difficult for this price to perfection market that we have in terms of, spread and rates. I just find it difficult. And again, if you're going to have all these rate decreases and have the market still be okay, I just think you're going to ignite inflation again. So I would say on the markets overall, I think it's going to be sort of a middling year. I think it's going to be a bifurcated year. I think the stronger names in high yield, which are higher quality and investment grade, will be fine. And then the question is going to be the weaker names, because you look at, say, private credit, for example. A lot of those names are struggling with interest coverage. And so that is going to be problematic. And so to sustain the cash flow as we have higher for longer in these rates, and the growth picture on top line revenues, I think is going to be challenged. And it's been surprising if you think about all the geopolitical difficulties in the world today that oil would be where it is. I think that's surprising. That's been a pretty good tailwind for markets. I think unemployment, again, priced to perfection. You see some of the temporary staffing businesses, they're sort of the early warning signal. They are slowing. And so I think, and hours worked are going up, and people look at the fact that they laid off a bunch of people during the pandemic. That it was hard to bring them back because it was all this fiscal support that was out there, unemployment insurance, and people would have to pay their student loans or their apartment bills, or mortgage, all this sort of stuff that was, pushed out or forgiven outright. And I think that's going to be difficult to have happen again if we have another downturn. So I definitely think there will be further dislocation and again, this dispersion continue to increase where, on the wider, more difficult, highly levered names are going to suffer disproportionately.
Yeah, I think of it as you kind of had the tailwind for decades, and then there was the shock wave. And you first you had COVID, and then you had the response to COVID, and then you had the higher the interest rate hikes in response to the highest inflation in 40 years, and you had this massive shock to the system. And there's going to be shock waves that are going to reverberate for years. And I think many people they just look at the recent past and they extrapolate that into the future. But unless you zoom out and you look at that big picture shock, I think you may be missing some major dislocations that'll happen. Is that how you think about it?
Yes, and many investors today, they've lived under the auspices of the Fed covers, all the issues. Everyone gets the trophy, right? We're that kind of generation. And so I think that, many people haven't lived through a recession ever. You could say, oh, different points, GFC, et cetera, but it really wasn't you didn't live in the 70s, right? You didn't live, and so 90s and, parts of the 80s. I mean, so I think there was, this complacency. There has been this complacency that has come into the market where the Fed is able to, I mean, like their job before was monetary policy, and then it became fiscal and monetary policy. And now we just, everyone has too much debt and everyone can't pay it. So you got two choices when you have too much debt, right? You can inflate your way out of it or default your way out of it. Well, we tried the inflate thing, and all that did was give us more debt. And now, that being said, the better companies have still a pretty good coverage ratio in terms of their, debt, to interest coverage ratio. But again, it goes back to this, bifurcated situation, and I always say the worst go first. So, I think it's incumbent upon investors to, look at what scenarios in prior cycles, and people look at the last 20, 30 years, and to your point about, okay, you've been a bull market for bonds for 40 years. So go back 100 years, what sort of, can happen in these markets? And they can say, well, it's different now, right? It's how many times you heard that, and that's like sort of the death knell for opportunities. If someone said it's different now, I get it. It's different because there's more liquidity, which is double-edged sword, right? I mean, people get used to. I remember them talking about high frequency traders and say, oh no, they're good for the markets. I said, high frequency traders are providing liquidity when it suits them. It's not like the old school, specialists on the floor exchange, if you remember those, and they sat there and they made markets and, and they ended up, getting carried out, right? I think it's important that, one should put this liquidity and the markets in perspective of what can happen and where the incentives are. The incentives are for them to, long-term capital, right? It's like, oh yeah, it's great, and they went and leveraged their balance sheet with everyone. Look at Olympia in New York, right? I mean, they pledged their balance sheet and their real estate to everyone, right? So, no, I think we're better today in terms of the structure, but there's still, I think, a fair amount of leverage that's predicated on, functioning, liquid markets that at times can get dislocated.
Yeah, that's for sure. One thing that I think is interesting, if you look at the last 30, 40 years, when you're in a falling interest rate environment, so I mean, for until 2022, we were either in a falling interest rate environment or near zero interest rate environment. And it's easy to refinance when rates are falling. Yet if you're in a period where rates are either rising or they just stay higher for longer, and maybe the economy slows, more like the 70s, that's not so easy to refinance. So that's a very different credit backdrop.
Yeah, I mean, you look at today as well, and you see the collateral and the banks continue to get squeezed. And so as you look at the private markets, they're getting larger and larger as the CUSIP market. And so, we've always had a very active and deep capital markets, and always seems to be solutions. But, if you look at, say, the private markets, they're not regulated by the Feds as, and the central banks as the public markets are. And so, there's just risks of excess that occur as a consequence. Refinancing, I mean, people take it for granted. And also, let's be clear, if there's an existing amount of debt that's out there and new debt becomes issued in, say, another credit, maybe that's, something that's interesting, and the people who own that say, I'm going to sell mine and buy that because that's a bit more interesting, maybe a bit more asset coverage or covenant protection or, interest rate, what have you. So you can have those orphaned existing, and then it becomes difficult to refinance. And again, these are fluid markets; they're not static markets. So you hit these maturity walls, and it might have been interesting when it was issued, but as I said, as the issuance and the credit profile can evolve, one can hold some security that is challenged in terms of refinancing because of its lack of investor protection.
Yeah, let's talk about this historic tightening that we had. Rates from 0 to 5 plus in a very short period of time. And when that happened, there was broad consensus. Almost everybody was thinking, okay, massive recession is next. You had an inverted yield curve. Yet here we are. The economy seems to be holding up just fine. Is your sense that it's just a lag response because of all the maybe the stimulus beforehand? And how are you thinking about this? And is the reckoning down the road?
I definitely think it's a lag response. The government, the Fed is still paying on balances, which was a GFC response. And so banks are still receiving money on deposit at the Fed. There was obviously the savings that was out there. There's a tremendous amount of private market response that was able to bail out a number of these companies. And then, as and I do think technology, innovation, and continue to control costs. It's continues to be amazing how markets have been able to evolve. If you, again, look at Europe versus the U.S. and our response, and they always say that Europe 75% funded by banks, 25% markets. In the U.S., 25% funded by banks, 75% markets. So there's a lot more flexibility in the United States in terms of access to financing and ability to refinance, to your point, than say Europe. Also, you have demographics. There's also this regulatory morass that the Eurozone suffers under, and then Brexit in the UK. And a lot of the banks have these floating rate mortgages. So people, the transmission system happens through refinancing. If you think about these higher rates, that's generally how it occurs, or refinancing, resetting, and so short duration or floating rate, it transmits more quickly. And so if you think of a homeowner in the United States, what they'll tell you is their best hands down asset they own is their 30-year 3% mortgage, because it's like, I nailed that one. Now, what's happening is it's technicals are such where you're not getting many people sell, right? Because they're like, no, I got to go refinance. I can't afford, So to unlock that value, that's the high prices. And so prices have stayed high. So rental market stayed high, supply stayed low. And so, it's kept those asset values higher. Now, compared to the Eurozone, which, more bank financing, more variable rate on mortgages, there's been a more pronounced slowdown. Now, refinancing is starting to occur because people are saying, oh, this tightening in the U.S. from 23 to 24 plus the 25 maturity wall, but these are some of the companies that we had felt that, geez, they're not going to get financing. They're going to hit the wall hard. They're able to refinance at the moment. Not all will. So it's going to be, again, the better quality credits are going to be disproportionately enabled to have access to cap markets versus some of the weaker credits. We like to say the worst go first. And so that's an important distinction to make. So I think it's just, will take time in these markets. And, it's due to a confluence of different events that has enabled this economy to continue to be robust, despite, what would many times historically. I mean, if you had said to somebody, there's going to be a war in the Middle East, there's going to be a war in Russia, Ukraine, where do you think oil is going to be? I don't think anyone would have, picked, oh, it's going to be 60 to 80, in terms of it'll got to be over 100, 120, 200, whatever. So I think that there has been this compartmentalization that has gone on in many markets, and, a function of, basically, it's the banks are in better shape. Private market solutions, some more liquidity associated, more dispersion has increased, but it's in the main, the bigger quality companies have done okay.
And obviously, we're late in the economic cycle. We haven't had a recession for some time. You had this historic, rise in interest rates. How do you think about maybe the lag effects of that affecting credit? And are there any specific sections or segments within credit that you're finding dislocations currently?
Well, I mentioned commercial real estate. So real estate, that's certainly one of the areas we do what's called LME, liability management exercises, where we take whether it's loans or private credit situations where we're able to go into as a solutions provider to a company, maybe sponsored, private equity sponsored, and provide a liquidity solution, very specialized to these companies. But there's a number of these opportunities out there. We have a CLO business, collateralized loan obligation business, where in structured credit we see a lot of companies and have relationships. We've been investing for quite some time, both in the U.S. and Europe, and we're able to identify these mispriced opportunities and come in and help bridge the liquidity gap that is occurring due to a in-depth analysis of these companies.
You've been very generous with your time, Brian. I want to end with one insight that you feel is unique that you've learned throughout your career that many may not have heard elsewhere. Is there one unique insight you'd like to share to close?
Yeah, it's hard. I mean, I think over the years we've always talked about, different ways to, approach markets. I've always felt that, you know, being able to be flexible in the mandate and being able to, you know, think about the first, second, third derivative of what influences a company is critical. And so I see many times there's a simplistic approach. However, as I continue to learn, I've learned that it's not only sort of the research edge, it's the trading edge, it's looking at, I think as I was saying earlier in terms of how we approach risk, but it's also operational risk, right? Do we structure this, covenant, and do we see, based on pattern recognition, some of the pitfalls that can occur with the improper documentation. So I guess, the insight is really a culmination of insights and putting it together and understanding that organizations are important. I think as we've observed that it's not just one part, and that's why having this ability to bring it all together is so critical as we look at what investment is suitable to be in our portfolio. It has to be, on a number of different traps, both macro, micro, both, trading, research, and operational. Is this something that is suitable, and what can go wrong? And so and then rolling that forward continuously. So I don't know that it's a particular differentiated, but it's, I think, differentiated in the sense of it's a amalgamation and a culmination of this, experience that continues to evolve.
That's great. Brian, I really enjoyed our conversation. I hope you and our listeners did as well. Thank you.
Oh, it was great being with you, Alex. Thank you, and always loved chat with you, and always love to talk about the opportunities in the market and King Street's ability to take advantage of them.
Great. Thank you. Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.